Today, I'm gonna be teaching my friend Hannah how to trade options in the stock market. Are you excited?
I'm excited.
Grab your phone. Let's see, you've got $500. So let's place this order.
Okay.
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 There you go, you're in. You're only gonna buy 3?
I don't want to lose more money.
Okay, that's fair. And at the end of this video, we'll see whether you're gonna lose money in your account or not. Do you know anything about trading?
No, I don't know nothing.
You don't know a thing. So I think first things first, I'm gonna walk you through essentially what a beginner would do. We're gonna simulate a beginner mistake, and typically what you'll see is someone will wanna learn how to trade and they'll open up a Robinhood account, and you've got Robinhood pulled up here on your phone and you deposited $500. I'm gonna have you choose a random stock and you're gonna buy what is called an option contract. Have you ever heard of options before?
Nope.
So I trade options. Okay, options essentially are gonna give you leverage. So if you have a smaller account, say $500, and in other case, if you're gonna trade shares of a stock, you're gonna be able to only buy, maybe one share. Say like one share of Microsoft is $400. You know Microsoft, the company?
Yeah, I know.
Okay,
the
so
company.
one share of Microsoft is $400, but one option contract could be $400. But that one contract you buy is essentially gonna give you 100 times the leverage. So you're gonna be able to buy really 100 shares of that stock. That's like the easiest way to think about what options are. So they give you massive leverage, so it's easier to make money, but inherently there's more risk. So without knowing anything else, grab your phone and you can choose a company you want. You can choose Microsoft or you can choose another company, any company, it doesn't matter.
Okay, I'll
And
go
we're gonna buy some option contracts.
for Apple.
Okay, great. And then you click on Apple. Now, what you're gonna do is hit trade. Okay, and then trade options. And so 2 things you have to know. When it comes to buying an option contract, you're gonna have to choose an expiration date,
Okay.
because that contract you buy is actually gonna expire at a certain point in time. And then you have to choose a strike price. And we'll get into more detail on what that actually means, but I'm just gonna let you choose an expiration. So you can see here
Okay.
on
What
the top
is
of the
that
screen,
expiration doing? Like,
we've got July 12th, we've got August 2nd, August 16th. Now, that is gonna determine when this contract or contracts you're gonna buy are actually gonna expire. I'm not gonna tell you how that's gonna influence how the contracts move, but just choose one randomly.
Okay.
And again, we're trying to simulate what just a newbie or a beginner would do. And then you could see here, we've got the various strike prices. So you could see like the 235 puts.
What are
You've
puts?
got calls and puts. Good question. So a put means you're betting on the direction of that stock to go down. And on the other hand, a call means you're betting on the direction of that stock to go up. So do you think Apple's gonna go up or down?
up?
So then you'd buy calls. So if you wanna go
What are calls?
buy calls, a call just means you think that Apple's gonna go up.
Okay, call is up and put is down. Put is
correct.
also so put is bad.
Or it could be good. So if you say, hey, if you want to bet on the direction of Apple going down, say you would buy a put. And if Apple goes down, you'd make money. So it's not like one is bad.
How
or
can I
good.
make money if it's going down?
That's a good question. So if you're buying just typical shares of a stock, you only make money when the stock goes up, when your shares go up in value, right? But with options and buying these option contracts, it allows you to trade either direction of the move. And so if the market's going up or if it's going down, or the stock specifically that you're trading, you're able to make money either way. So that's the cool thing about options.
Okay.
So you could say, hey, I think Apple's gonna go down, and you'd buy a put.
Okay.
But if you think it's gonna go up, we're gonna go buy and buy a call. Okay, so that's what you have pulled up right now. And then you could see you have the 220 calls, the 215 calls, the 210 calls. Those are called the strike prices. I like how Robinhood displays it, even though Robinhood's not great. So the share price is $210.54 currently. That is for one share of Apple, it would cost you $210 just about to buy one share. So with calls, anything below the current share price, you can see all the green ones right here. Well, they're currently highlighted green because they're up on the day. Those are called in the money contracts. So again, if you're buying a call, any strike price, okay, you can see the 210s, 205s, 200s. These are all below where Apple is currently trading at. Apple is currently trading at 210.59. These are the 200 calls. So those are in the money. And on the other hand, all these contracts above, okay, the current share price, so 215, 220, 225, these are all above where Apple is currently trading at. Well, those are all out of the money.
Out of the money?
There's in the money contracts and out of the money contracts. So these are in the money, these are out of the money, and one of them is riskier than the other, but I'm not gonna tell you. I just want you to choose one.
I think the green looks good.
All right, so let's see, you've got $500, so you gotta also make sure that you can afford the contracts you wanna buy. And right here, you can see the cost of the contract, like $360, $545, $790. Those are the actual, prices of those contracts. And because of the leverage, see how it says 7.90. Most people think that means $7.90. It means $790.
Oh.
So if you just move the decimal over, you can see that contract's about $800. So you have $500. So you couldn't buy, unfortunately, any of these, but if you choose a closer expiration date, they might be cheaper. So it really just depends. So that one's $450 for one contract. So you could buy that one.
Okay, should I buy it?
Or you could buy like 20 of these or more. Those are only 48 cents or $48, right?
But why is it red?
So, I don't know, maybe today Apple's up and I don't know, they're down. We'd have to look at the chart. But anything right now that's in the money is green on the day. And all of these ones that are out of the money are currently red on the day.
And how do I know if they maybe are becoming better?
That's a good question. Well, in theory, they'd become better if Apple went up, right? Okay. But it's up to you. I'm not going to talk anymore. I'm going to let you buy whatever contract you want to buy. If you want to buy 50 of those cheap ones or one more expensive one, it's totally up to you. So you just click on the plus and then it'll take you through.
Okay.
So right now, how many contracts do you want to buy? These are $45 a contract.
Like 3?
So just hit 3. Just click on this. It should be good. So yeah, you're going to buy, in this case, if you hit review and send 3 Apple contracts, these are the $217 calls expiring 6/28. Okay? Good? All right. So at the end of this video, we're going to check back in and see whether you made money or lost money. So let's place this order.
Can I lose a lot of money?
You could lose your entire account. All right. Ready? Let's go.
God.
Oh God. Okay. Review, click review and swipe up.
Okay.
Okay?
Okay.
Do you want to buy more?
No.
There you go. You're in. You're only going to buy 3.
Okay, how fast is this like going up or down?
So you just bought $138 worth of contracts, but you still have more money in your account.
Okay, and can you tell me which one is good?
Hopefully at the end of the video, I'll be able to teach you so you can learn which one would have been good in this case.
Okay.
All right, are we good? Do you want to buy more or do we want to hop on inside my computer? I'm going to teach you the right way to do this.
I don't want to lose more money.
Okay, that's fair. You're good. You're conservative. I like it. All right, let's hop on inside my computer. And at the end of this video, we'll see whether you're going to lose money in your account or not. Okay. Now it's time to learn how to, actually trade options. And what I mean by that is, you chose a random stock and you wanted to bet on it going up. But why did you want to bet on Apple going up? Just kind of intuitively.
Yeah.
Just random,
yeah,
right?
Just random.
So the goal is for us, and by the end of this video, for you to be able to look at a chart. And right now we're looking at the S&P 500, which is like pretty much a collection of the 500 largest stocks in the stock market by market cap. So this is like going to give us a really good indication of where the overall market is at. And I want to show you how to look at a chart like this, and based off a couple things that you're going to learn today, how to actually decide from an educated perspective, not just from intuition, what direction we want to bet on a stock going. So we can look at these, what are called candlesticks. And each one of these little candlesticks represents the 4-hour time frame.
Which 4-hour time frame?
You can see the black bars here. Okay, there's the gray and the black. So the black is like active market hours. So the market opens at 9:30, closes at 4. And then there's an aftermarket trading session and a pre-market trading session. And as option traders, we can only trade within this black bar when the market's open. we can hold our contracts to the next day, but we can't buy or sell in this gray. So I'm looking to essentially buy a contract today in the black and hold that into the next day in the black, or multiple days. So we're trying to capitalize on like an overnight or morning movement of the stock where we can't buy or sell during that time, but we're hoping the stock will go in our direction during that time.
So you just hope if it's going up or down.
I don't like the word hoping, and you like took it out of my mouth. I don't like the word hoping, but we're gonna use a couple, I don't like to call them indicators, but they're gonna give us indication more on what direction a stock is gonna go. Have you ever heard of like a moving average? I know you know nothing about trading.
No.
So moving average is gonna essentially give us like a very visual way of understanding the average price movement of a stock. Let me just show you. I'm gonna add this real quick. So what you're gonna see here, I've added these 3 moving averages that I use to trade with.
So the blue and the red and the green line.
Yeah, the blue and the red and the green line, and they all represent different periods of time. So we're gonna look at these lines, and then we're gonna look at these candles, okay, these candlesticks, knowing that all of these represent 4 hours of time. And we're gonna make a decision on what direction we think that stock is gonna go based off of essentially the interaction when it comes to where the candles are trading in relation to the lines. Make sense? Mm-hmm. The green line is the largest moving average. It is gonna take into account the longest time frame when it comes to the amount of days we're looking at. We're looking at the average movement over 180 days. Okay, that's what this green line is. Mm-hmm. It's called an SMA, or a simple moving average. You don't really need to know that, but if you want to pull this up on your chart, this is what you'd pull up. You'd pull up 2 SMAs. So the green line is the 180-day simple moving average. And then you can see here the red line, that's our second SMA, simple moving average. Well, that is the 50-day SMA. So that is going to take into account the average price movement over the last 50 days. And then the third is going to be the EMA. Okay, it's called an EMA, or an exponential moving average. That is that blue line, and that blue line is going to represent 15 days worth of the average price movement of, well, in this case, we're looking at SPY.
Can we also look at Apple?
We can look at Apple, but if we do right now, it'll pretty much, you'll be able to tell if you're up or down. And I think we should wait to see, because I don't know, it's fun. We'll wait until market close, and then we'll make sure at market close, before the market closes, we'll check your Apple position and we'll get out of it. But let's look at, like, I don't know, what's a stock? Microsoft, all right? So
this is going up.
Microsoft, you can see, is going up. Now, what this is called, and pretty much the first thing that I like to do is look at a chart. Once we've got these moving averages applied, you have a general understanding of what they are. Well, we want to look at the trend. And the trend here, is going up. Yeah. And so that would be called bullish. This is a bullish trend where essentially the chart and the candles are moving from the bottom left to top right of the screen. And on the other hand, if the candles were moving from the top left to the bottom right of the screen, so the opposite, if the trend was the opposite, that would be, well, bearish. And right now, knowing that SPY, kind of the overall market, is sitting up very close to its all-time high, well, we can expect that most stocks, well, they do follow the overall market, and most stocks will look like this. Most stocks right now will have bullish trends. So using these moving averages and looking at the trends, I have 3 what I call setups. Now, a setup is a way that I essentially define what I see on a chart. Now, 2 of those setups are what are called bearish setups, where I am betting on the direction of that stock to go down, where I'm buying puts. Mm-hmm. So if I'm looking at a chart, well, I'm gonna look to identify hopefully one of the 3 setups. Sometimes there won't be a setup, but what I'll do is I'll go through a bunch of charts that look like this, and I'll look at them, and this is what you're gonna learn. Well, how do we identify if there's a setup there or not? So 2 of the setups, I'm gonna be buying puts. 1 of the setups, I'm gonna be buying a call. So 2 bearish setups and 1 bullish setup. So I'm able to make money essentially with the way I trade, whether the market's going up or down, because I have that flexibility within these 3 setups. So I'm just gonna essentially teach you one of the setups. And all we're gonna look at is, like I said, where are these moving averages trading in correlation to the candles, or vice versa? And I'm gonna use one of the bearish setups. I think we'll go with the bearish setup. So, you know, this setup, you would, like I said, buy puts. Now, we want to essentially look for a chart where the trend is bullish, but we're going to be looking to buy puts. So we want to find a bullish trend, okay, very similar to this. And we're going to look for a chart that is sitting right at its all-time high. So you can see SPY has pulled off of its all-time high, right? We want to find a chart that, you know, is very close where it says high, whatever the, you know, price is. We want to find a chart that's sitting right around there. And what we want to do is essentially bet on that stock to go down. And we're going to use these moving averages to determine if it's a trade we can take or not, or if, yeah, we should take the trade in the first place. So let's go through a bunch of different stocks in the S&P 500, okay? So
What is S&P 500?
So the S&P 500 is essentially a collective of the 500 largest stocks by market cap in the stock market. And like I said, it's like a very good way to gauge where the overall market is at. So in the S&P 500, you've got Apple in there, Microsoft. We can just slowly go through all of those and look at all the charts. There's different ETFs. There's the NASDAQ, there's the Russell. There's these pretty much groups of stocks. And you can just buy that single name. You can buy SPY, which is kind of like, in a way, owning all 500 stocks, or you could go buy the individual stocks in SPY.
Okay.
So we'll go to essentially trade one of the individual stocks in SPY because I don't trade ETFs. I could, but I don't. Any questions so far?
What are ETFs?
Just think of it as like an ETF has a bunch of stocks in it.
Okay.
And it like gauges where they're all heading. Like this is the average movement of all the stocks.
Okay.
So we're gonna go through here. We're gonna try to find the S&P 500, and you can see like there's S&P 100, 400. I'm gonna click on the first one. What we're gonna do is we want to identify first a bullish trend. So we wanna see, you know, movement is going from the bottom left to the top right. Some of these I've drawn on, you can see we wanna find one that is trading at its all-time high, okay? So that's like very close. What I'll do typically is I'll go through these charts and then I'll kind of pull them out, add them to separate watch lists, and then I'll go back and look through them again. But we can kind of just scroll through here, and I want you to tell me what essentially the trend is. And just, you know, let's be aware we're looking for one where, you know, that chart is trading at an all-time high. So you see we're down here at $69, okay, on Uber. And the all-time high was 82. So we're significantly far off the all-time high.
But now it's going down. No, now it's going up again.
So in some charts, it's really hard to identify the trend. So like this one, it is pretty hard to identify the trend because it's come down quite a bit off of that all-time high. And this one is pretty much trading like flat or sideways. So you can say no trend. What's the trend on this one? Like the overall trend. Bullish and bearish. Bullish. That's all right. So remember, bottom left to top right is bullish. Top left to bottom right is bearish. So that would be a bullish trend.
Bearish is down, bullish is up.
Yeah, exactly.
Okay.
I know it's a little confusing, but even though this is a bearish setup, we're looking for a bullish chart because we're gonna buy puts. We want to bet on this stock to go down, and kind of the overall understanding of the setup and what I call it is the all-time high pullback. We're looking at a chart that is trading at an all-time high, and something that keeps going up is eventually going to come down.
Okay.
There's guessing and there's gambling and there's trading, but the idea is that we want to use like all the tools, or in this case, moving averages, to make the most educated decision we can. At the end of the day, like, I don't know what's really going to happen. No one knows what's going to happen. But if you do something, the same thing in the same way, time and time again, you'll see how many times you're right. And so based off of this all-time high pullback setup that I've been trading for the last 3+ years. And I've been trading for almost 8 years now, but this setup specifically, I've been trading for 3 years, and I know I have about a 70% win rate, which means about 70% of the time I'm right. And the other 30% of the time I'm wrong. When I'm working with some of my students, when they start out, recommend that they just start by trading fake simulated capital, like paper capital. So it's fake money, and it just allows you to get that experience without actually losing your money, right? I think for a beginner, I would recommend starting out with paper capital. So no trend there, it's not great. This looks like a bullish trend. Do you agree? That's bullish?
Yeah.
Bullish trend. Now, I actually like this one. What we want to see here is that moving averages are what I like to call being respected. Now, respected just means that the candles are not trading straight through it. Okay, so when it comes to these three moving averages, the 180 day, we want to see that pretty much throughout the entire duration. When we zoom all the way out and look at the whole picture, that candles are either trading above or they're trading below. Not that they're trading straight on that moving average. Because if they're trading right on it, like they are here, see how they're just kind of chopping up and down on it? Well, they're not respecting that moving average. And we want to see if a moving average is essentially respected or not, because that is going to tell us if we can use that level as what is called a support or a resistance level. So you've got support, and support is like the floor, and resistance is like the ceiling.
Okay.
And if we can see that looking at the past, looking over the last 180 days, we can see that if a moving average is respected, if candles are trading above that moving average, it would be acting as support. So in this case, this isn't a great chart. Let me find a clean chart, and I typically like to trade very clean and clear charts because they're just going to give us much more certainty when we go to take that trade, because we want to see where charts where moving averages are really respected, and that is going to let us know and give us like an easy visual way to see, hey, there's either support or resistance here based off of whether the candles are trading above or below the moving averages. And so a lot of these are really choppy, as you can see right now. Okay, looks like this is a bullish trend, and we can see here the 180 day. It looks like it's being respected. So candles are trading above. They have been trading above the green line for, the last several months. And we can see that when candles have pulled back, we've seen this, for example, this candlestick pulled back into the green line, but it bounced off and it continued trading higher. Pulled back again, but look it bounced off right there. And then it continued trading higher.
So that's a pretty safe trade.
So it's respected. And what we'd do in this case is we'd say, hey, this level is acting as support. Candles are trading above, which means this moving average is acting as a support level. Now, it could work in the other way where the candles were trading below the green line. And if that was the case, it would be acting as a resistance level. When we're looking for a setup, preferably, we want to see all the moving averages are being respected. And if you count out individual days, okay, we would want to see that 180 days, well, all the way back 180 days, that green line has been respected. And then the red line, the 50-day, we would want to see that 50 days, the red line has been respected. So right now we're on the 4 hour and we're looking back over the last 180 days. So we can see here, virtually this thing has been respected the entire time, right? Pretty much coming off lows. That's great. And then we'll go back to the last 50 days. And, generally so we don't sit here for the next 10 minutes counting, there's a tool I built that'll actually tell you this really quick, but we want to see, okay, the 50 days being respected, which it looks like it is, right? We broke above, and this was, this looks, it's about 50 days, right? Let's say that's 50 days, pulled back, bounced off the 50 day, okay, validated that level of support, and then has just pushed into an all-time high. And lastly, we want to look at our third moving average, right? We looked at the 180 day, we looked at the 50 day, both of those are respected. That's great. And if we were to say have a checklist and we wanted to check off all three, or that all three moving averages were being respected, there's 2. And we could see over the last 15 days, and this is something that I want to note, the market likes to essentially probe areas. What will happen is, you'll see candles pull back or retrace below a level, but then they'll remount. And what happens is newbies, beginner traders, they'll look to get out of the trade the second that, candle breaks that moving average. So essentially the market just likes to take people's money, right? And so this is a great example where, one 4-hour candle pulled back below the 15-day EMA. People got stopped out, they lost money, and then look, it remounted. So you'll see that happen. And I've built ways to essentially get around that and determine where to set that stop loss so you don't get stopped out like most beginners would. But we can see overall, the 15-day has been respected. So we've been trading steadily above the 15-day, pulled back, bounced off our floor, right? because if candles are trading above, each moving average is acting as a floor. And we want to see that floor is able to hold. So the floor held, and then we pushed back up, and now we're sitting right at an all-time high. Now, here's what we look to do. We want to play a move off of this all-time high back down into, well, either the 50-day or 15-day. So we could buy puts right here and trade down to the 15-day EMA or trade down to the 50-day SMA. And you can see why we're doing that is essentially we're looking back, obviously, at the historical data here. We're taking into account these factors. We're looking to see, whether these moving averages are respected or not. We're looking at the trend, and we could see, okay, we bounced off the 15-day EMA. Okay, we started trading to the upside. We pulled back. We bounced off again. So say, you got in here, that would have been an all-time high. Like if you couldn't see anything here, this would have been an all-time high. If we bought puts, well, we would have traded and played the move back down to the 15-day, locked in profit, and then it pushed up, oh, new all-time high. Let's trade back down to the 15-day or even the 50-day. So this is obviously looking back at the past, but ultimately how we would have traded this chart would have been, here's an all-time high. This is where we get in. This is where we get out and take profit. Okay, all-time high. This is where we get in. And then let's say this is where we get out. We could have played that entire move.
But how do you know that
this is where we get in? This is where we get out. Because we're looking, look at how many times this has played out. Look at how many times we formed a new all-time high,
True.
retraced to the 50-day, formed an all-time high, retraced to the 15-day, and then the 50-day. So we could have taken profit here, sure. So 1, 2,
So you
1,
could do
2,
it now again.
1, 2. So yeah, what
So
if
now we would think it would also go down again?
we'd get in here, okay? And then we could play the move back down to the 15-day. We could get out there, or we could say, let's play the move back down to the 50-day. So we could have 2 targets, we could have 1 target. So with trading, there's no rules, absolutely no rules. Like you create your own rules in trading and you decide what works for you. In the way I've gone about trading, I've done it in a very systematic way where I have rules set in place and defined where I would only have one take profit level. I would either go for the 15-day or the 50-day. And if, this didn't get hit and we ended up, continuing to push, then I'd get out. Some people would sell part of their position here and then hold the rest and sell the rest here. But in this case, let's keep it simple. Let's say we entered here. You can, make it kind of colorful. So let's say we entered here, okay? And then that was our entry point. And then we, to be conservative, wanted to set our take profit. And it's better to use an actual line instead of a box. So we would actually be specific here. Let's say this is our take profit. So that's where we're gonna look to take profit on this trade right there, right? And then I'll remove this. Let's say we get in here. I could draw just a white line here. So obviously, if we entered right now, okay, we would set our stop loss. And I have a little tool here. So we're gonna go, we're gonna add ADR. Now this is a little calculator I built. We're gonna apply this here real quick. Great. Okay, so you can see here, I just added this ADR calculator that I built. We could see the average daily movement over the last 180 days is about 1%, 0.91. So on average, this stock MSI moves about 1% a day. And we can see over the next 3 days, it's projected to move 2.73%. So what I do when it comes to setting my stop loss, because there's no candles we can look at above here. We're sitting at an all-time high. So what I do here is I'm gonna go ahead, I'm gonna set my stop loss 1% above. We can go ahead, we can draw that out, drag up, okay, to see, you can see the percentage here. So I'm gonna be wrong if this thing moves up 1%, because over the last 180 days, on average, it moves 1% a day. So there is my stop loss, okay, and we'll make that red. And there is my take profit, which is going to be green. So this is gonna be my trade plan. We're gonna enter. I'm gonna make money if it gets here. I'm gonna lose money if it gets there. So that is the ATH pullback setup. Now, I know there's a lot more to cover and we'd be here all day. if I want to show you everything. But what I'm going to do is I'm going to get you set up. I'm going to get you inside my mentorship group. I've actually created pretty much a curriculum. I've created a ton of videos that are going to walk you through step by step and teach you this exact strategy and the other two. So you're going to learn all 3 setups. You're going to get access to all these tools I've created and essentially just my entire knowledge pool after trading for the last 8 years. So I'll get you in that. You could go, you can learn at your own pace in your own time, and you'll also be able to kind of see the trades that I'm taking. So I'll send you the trades when I enter a trade myself and when I get out of the trade.
Trade the same.
You could trade the same as me if you want, or if you want to learn this kind of lifelong skill, right, of trading, you can learn on your own. So it's up to you, but I'll get you in the mentorship group. Now, if you guys want to learn yourself, I'll put a link in the description below to the mentorship group. How do you feel? Are you excited?
I'm excited.
Awesome. We're going to see whether you ended up making or losing money. So
okay.
Let's click on Apple and let's see. Oh no, it looks red. You want to scroll down and see? Pulls down. Oh no, how much did you lose?
63.
You lost $63? Oh no.
How is it going down so fast?
So you're down 47%. Or
good that I didn't spend more money.
$66. That is a good point. I think you did do a really good job at managing risk. You had $500 in your account and you bought about $130 worth of these contracts. Unfortunately, as a beginner, and this is what happens with most people, and that's why I wanted to show this. And don't worry, we'll cover your losses here. I wanted to show you like what happens to most people. Unfortunately, people come into the market and they're not educated and they gamble, they use intuition and they lose money. So that is why, you just learned essentially this. It's a little less. That's why I was able to sit down with you and why I really want to teach you at least this one setup. So, you could learn how to do this yourself and hopefully make money without just guessing.
Yeah.
Okay.
Oh, it's going up.
So we're going to close out of this trade. We got to cut our losses. You're going to hit trade.
Okay.
And unfortunately, we're going to have to just sell our 3 contracts. So you can hit 3, review, and we can swipe up to submit. All right. You want to see how much are you sad?
A little bit.
A little bit. So you ended up losing $51.
Oh, well, that's okay.
That's okay.
Not too bad.
Now, I do have to say, that's part of learning. It is inevitable. Even if you're, eventually you're going to have to make that transition from trading with paper money to trading with live capital. And like I said, part of trading is losing. I plan on losing 30% of the time, which means with this setup that you just learned 30% of the time, I'm actually going to be losing money. And you just, in trading, have to think of that as essentially your business expense. Like you will lose money, but that's okay.
Okay.
Thank you for coming on. Hope you guys did enjoy this video. We'll see you.